The Little Book of Common Sense Investing by John C. Bogle is a concise yet powerful exploration of the principles that form the foundation of successful investing. Bogle, the founder of Vanguard Group, advocates for a straightforward, sensible approach to investing that emphasizes low-cost, long-term strategies over the pursuit of quick, speculative profits. The book's central message is simple: to achieve investment success, an investor must focus on a low-cost, broadly diversified portfolio of index funds and avoid the pitfalls of trying to outsmart the market. Bogle's core argument is that most investors, including professional fund managers, fail to beat the market consistently over time. This is due to the fact that the market's overall returns are shared by all investors, but fees and other costs take a significant portion of those returns. Instead of trying to pick individual stocks or time the market, Bogle advocates for passive investing through low-cost index funds that mirror the performance of the overall market. By doing so, investors can achieve the market's average return, which, over time, will outperform the results of most actively managed funds. The book begins with a critical look at the performance of actively managed funds, emphasizing that despite the high fees they charge, these funds rarely outperform the market in the long term. Bogle explains that fund managers may have occasional success, but their ability to consistently generate superior returns is limited by factors like high turnover rates, the costs of research, and the inherent unpredictability of the market. The evidence shows that, on average, actively managed funds underperform index funds due to their higher fees and the inability to consistently pick winning stocks. Bogle contrasts the high costs of actively managed funds with the low costs of index funds, which are designed to replicate the performance of a market index, such as the S&P 500. Because index funds don't require the same level of management, their fees are much lower, and these savings compound over time. Bogle argues that the key to successful investing is to minimize costs while maximizing exposure to the broader market. He highlights the importance of diversification, which index funds naturally provide by holding a wide array of stocks, reducing the risk of any single company's poor performance significantly affecting the overall portfolio. A key concept in the book is the cost of investing, which includes not just the management fees of funds but also trading costs, taxes, and the impact of short-term speculation. Bogle stresses that every dollar spent on fees is a dollar that doesn't contribute to an investor's return. Over time, these costs can significantly erode an investor's wealth. By contrast, investors in index funds benefit from compounding returns that are less impacted by fees and expenses. The lower the costs of investing, the greater the chance that an investor will keep more of the market's returns. Bogle also emphasizes the importance of a long-term perspective in investing. He argues that trying to time the market or chase after short-term gains is a losing strategy. Instead, investors should remain patient and disciplined, focusing on holding their investments for the long haul. Bogle advocates for a simple asset allocation strategy, recommending that most investors hold a combination of stocks and bonds, adjusted for their risk tolerance and time horizon. This balanced approach allows investors to ride out market volatility and capture the long-term growth of the market. One of the key messages in the Little Book of Common Sense Investing is the idea that investors should take responsibility for their own investment decisions and avoid being swayed by the noise of the financial media. Bogle encourages investors to ignore the short-term fluctuations of the market and the constant stream of predictions and opinions from experts. Instead, he advises focusing on the fundamentals, investing in low-cost index funds, staying the course, and avoiding the temptation to make frequent trades based on fear or greed. Another important aspect of Bogle's philosophy is his belief in the role of discipline and patience in investment success. He stresses that the path to wealth is not through chasing trends or trying to predict market movements, but through a consistent, steady approach to investing. By focusing on long-term goals and ignoring short-term distractions, investors can build wealth over time without succumbing to the emotional impulses that often lead to poor decisions. Bogle also explores the concept of market efficiency, which asserts that markets are generally efficient and that it is difficult, if not impossible, to consistently outperform the market through active management. He argues that since all information about stocks is already reflected in their prices, the idea of outsmarting the market by picking individual stocks or timing the market is flawed. Instead, Bogle suggests that investors should accept that they will never beat the market and instead focus on matching the market's performance through a diversified, low-cost portfolio of index funds. The book concludes with a call to action for individual investors to take control of their financial futures by adopting a simple, common-sense approach to investing. Bogle encourages readers to avoid the complexity of active management, ignore the hype of financial media, and instead focus on low-cost, passive investing strategies that are based on proven principles. He concludes that, while investing may seem complicated, the best strategy for most investors is simply to keep it simple, invest in index funds, and stay disciplined over the long term. In summary, the Little Book of Common Sense Investing offers a clear and compelling case for passive investing through low-cost index funds. John Bogle's insights challenge conventional wisdom about active management and market speculation, urging investors to adopt a more rational, disciplined approach. The book teaches investors to focus on minimizing costs, diversifying their portfolios, and maintaining a long-term perspective. By doing so, they can achieve superior investment results with less risk and lower fees. Bogle's advice is both practical and timeless, making this book an essential guide for anyone looking to build wealth through investing.